To bring us some analysis, I have with me Michael Kitson. He's an economist at Cambridge University's Judge Business School. Welcome. Thanks very much indeed for coming in. So we have there 0.8% growth in the third quarter, down from 1.2% growth in the second quarter, but still higher than consensus estimates.
Yeah, good figures, but we've got to bear in mind here that quarterly figures go up and down. They're a bit of a roller coaster, so we shouldn't take too much focus. It's only one piece of the jigsaw by looking at 0.8%. Good figures at the moment, but often just quarterly figures. They will be subject to revision. What we really need to look at is what growth can be like over the next 2 or 3 years. There, I think actually growth is likely to be significantly less than we achieved this year, and there still may be some revisions to the Bank of England's policies in the future.
So you're expecting what, subdued growth in the fourth quarter? Low consumer confidence?
Yeah, I mean, what we've got to think about here is this growth. We're backward-looking, and actually we've got the remnants of the previous government's expansionary policies. What we've got to think looking forward is what the impact's going to be of the fiscal contraction that was announced last week. What we're likely to see is growth being significantly lower next year and the following year, below trend and below a significant increase you'd expect if we had a big bounce back from recovery. We're going to have a slow bounce back from recovery, and that may have significant implications for policy next year and the following year.
And that's the key thing, isn't it, is factoring in that spending review, which, as you say, these backward-looking figures don't. I mean, we're talking about 500,000 public sector jobs gone, spending cut by £81 billion over the next 5 years. How much is that going to shave off growth in the next few months and next year? OK,
it's very difficult. We know economic forecasting is just informed guesswork rather than a science. Okay. But informing some guesswork, we could perhaps expect growth over the next 2 years to be about 1.5%, 1.6% both annually next year and the following year. That's significantly below trend, and it's significantly below what we'd expect in terms of the government's fiscal policy. We're likely to see it very difficult to hit its budget targets with growth rate of 1.6%, 1.7% over the next couple of years. So I still think there may well be a potential for the Bank of England to engage in some quantitative easing.
Well, that was precisely my next question. What are the implications of this GDP report for that decision?
Oh, it's reasonably good news, but it's only one small part of the story. I think they'll be forward-looking. We can see that the housing market is still depressed and is actually maybe going to a double dip. That's going to affect consumer confidence. We're going to see slow growth. It's difficult to see where growth's going to come from next year. Individual consumers have still got high levels of debt. The public sector, we see fiscal retrenchment. The firms are unlikely to invest, with consumers still very concerned about their debt position. And we've got very limited ability to export our way out of recovery. So
it seems to be a question of whether or not there is enough bad news on the real economy to justify further QE printing more money.
I still think there is still like to be bad news looking forward in terms of the growth. We are going to have growth. We're not going to have a double-dip recession, but the growth is going to be moderate. There's still maybe latitude for the Bank of England to engage in quantitative easing, but the constraint the bank has is inflation is still well above its target. So it's got to try and keep the markets happy that it's going to keep its inflation target, but then also looking forward to what the growth rate is likely to be in the future.
So why is the Bank of England keeping interest rates so low when inflation is running above target?
Well, the bank always says it's looking 18 months, 2 years ahead. So it's saying inflation is likely to be falling in 18 months and 2 years. So it's forward-looking inflation, but inflation has got to follow that downward path starting next year. Otherwise, it's going to be in a double bind. Slow economic growth, high inflation. That's a real problem.
Michael Kitson, economist at Cambridge University. Great to get your thoughts. Thanks very much.
Thank you.
Now,